Hello and welcome to State of the Economy, a show that connects you with key policymakers and thinkers. Today we have with us Dr. C Rangarajan, Chairman of Prime Minister's Economic Advisory Council, who will tell us more about some of the budget assumptions and how they will pan out. Welcome to our show, Dr. Rangarajan.
Thank you.
To start with, the market initially actually absorbed the budget and actually found that the budget assumption, especially fiscal deficit, was realistic and achievable. That was the initial reaction. But in the days following, Dr. Rangarajan, some bit of skepticism is creeping in about how the subsidy will be contained at 2% of GDP, especially given the oil prices where they are at $125, $26. So, could you just tell us about how the link between the international oil price and the subsidies will pan out?
The finance minister had two broad objectives before him. One was to accelerate economic growth, and the other was to contain fiscal deficit so that it will provide the appropriate environment for sustained high growth. In many ways, he has delivered on both. I particularly welcome the strong statement that he has made on containing the fiscal deficit.
And biting the bullet, he said.
He has given a roadmap too. It will go down by 0.8 percentage point in the next fiscal, and it will go down further in 2 years' time. It will go down to about 3.9%, and perhaps by over a period of 3 years, we could get back to the FRBM target of 3%. Therefore, the finance minister has laid a lot of emphasis on fiscal consolidation. To buttress this proposition, he has also indicated that the subsidies as a proportion of GDP will also go down from the current 2.4 or 2.5% of GDP to something like 1.7%. It will go down to 2% next year, but it will go down further in the coming years.
But that would require correcting diesel prices in the main?
Yes, there are three major subsidies. One is the food subsidy, the other is the fertilizer, and the third is the petroleum subsidies. As far as food subsidies are concerned, in the next fiscal, what he has provided for may be just adequate, because the full Food Security Act may not come into force till the end of December of the current year.
So the full impact will be felt only in
the next fiscal.
Yeah.
He certainly will have to provide much more than what he has provided in the current year. But what he has provided is still a little more than what was provided, or what was the level of subsidy last year or in the current year. As far as fertilizer subsidies also, they are reasonable. But both fertilizer subsidies and petroleum subsidies imply that action will be taken during the course of this year. Such action may take several forms. One is a total decontrol, let us say, of the prices of diesel, or some kind of arrangement under which the diesel prices are progressively reduced. Therefore, implicit in the subsidy level indicated in the budget,
there is a roadmap. There is a roadmap for price.
There is a clear indication that policy actions are required or called for during the year.
So in the next 3 months, we'll see something in this regard.
I think so, because
the Prime Minister also has made a statement that the government has to bite the bullet. He used the word bite the bullet.
Yes, I think many of us have been saying this for some time. We had also indicated in the review of the economy that action on the diesel front is required. Therefore, there are alternative ways of doing it, but by and large, the objective should be to ensure that the subsidies made available by the government directly are pegged at the budgeted level.
But sir, there is also some talk about some kind of dual pricing of diesel to be implemented, considering that the farmers, Uttar Pradesh Samajwadi Party has come in to support the government from the outside. which it was already, but it has reinforced its support. And their leaders have said that the farmers should be somehow be insulated from very sharp diesel price hikes, because they're already reeling from the fertilizer problem in UP. In UP, fertilizer non-availability and price of fertilizer was a big issue among farmers in UP. Do you think some sort of via media can be found?
I think dual pricing in any commodity is going to be very difficult because it is very difficult to prevent what we might call seepage and leakage. Therefore, what is best would be to go for a straightforward increase in the price of diesel. I have seen some suggestions and looked at them very carefully.
Or the very weaker sections?
Then that requires a completely alternative system, in the sense that it is not through the price mechanism that you are doing it, but you are giving the beneficiaries, the identified beneficiaries, a cash subsidy directly, leaving the price to be market determined, but the beneficiaries will receive a certain amount of cash subsidy which will provide the cushion. But what I am saying is that ultimately, whether you provide a cash subsidy directly or you adjust the prices, the total burden on the government should not exceed that level that has been indicated in the budget. Otherwise,
which is 2% of GDP, or
that is at 45,000 crore or something like that, close to it, which has been indicated in the budget. So there are alternative ways of doing it, but dual pricing appears to be a very difficult thing to do.
So coming now to the overall borrowings in the budget, it appears that in spite of the fiscal correction, which is quite substantial, as you said, 0.8% nearly.
0.8.
Yeah, 0.8%. It seems that the total market borrowings, gross borrowings, are still much more than what the government has borrowed this fiscal. It would be of the order of 5,60,000 crore or thereabouts. So do you think that will put pressure on interest rates in the economy? Because one is also seeing market players saying that the yield, government bond yields are already hardening, indicating that this level of borrowing, whether the market will be able to absorb in the next 1 year?
Well, in order that the gross market borrowing and the net market borrowing program during the next fiscal is lower than the current year, the reduction in the fiscal deficit that would be required must be even greater. Therefore, I think given the fact that the nominal GDP during the next fiscal will be growing close to 14%, the gross market borrowing program being retained slightly above last year's level should not pose a serious problem.
So here we'll take a small break. Please don't go away. Keep watching Raj Sabha Television. Welcome back to State of the Economy. We are having a conversation with Dr. C Rangarajan, Chairman of Prime Minister's Economic Advisory Council. Sir, coming back to another important assumption in the budget, which is inflation. Now, inflation is assumed for the coming fiscal at 6.5%. Do you feel that that might be a slightly ambitious target, considering that there are some cost push inflationary impact on account of excise and service tax increases, and thereafter when some of the oil prices get corrected, they would also feed into the inflation rate. So how do you see inflation rate panning out?
I would not regard an inflation rate of 6.5% as ambitious. I mean, I think we really need to go even further down. I think it is not a tolerable situation to have inflation running at 6.5%. after having had inflation exceeding 9% for 2 previous years. I think we must work towards a much lower level of inflation. Now, coming to the possibility of whether we can achieve that or not, let us look at what are the major factors. First of all, we are starting with a high base. Therefore,
so that goes in your favor.
That would itself probably show the inflation down in the next fiscal. After all, almost until the end of December last year, from April to December, we had inflation running at a level above 9%. Therefore, one could see as a consequence of this some moderation in the rate of increase in prices during the current year up to December. Therefore, in the absence of other factors, I would have expected that the inflation rate will come down to 6% or a little below 6%.
But you also imagine that that the demand, the effort by the monetary authorities to slightly depress demand has also taken place. GDP is now down to 6.1% in the third quarter of last fiscal. So, will that also lead to a slight moderation of inflation?
Well, the demand pressures, particularly what we would call monetary demand, I mean, that is, it's not really the real GDP, but it is a monetary GDP which is really the factor. So, if the moderation in money supply growth continues during the year, then it will also help. Now, to come back to your original proposition, I think in the absence of other factors, I would have expected the inflation to come down a little below 6%. But add to it the other factors that we have to take into account, like the impact of the rise in the excise duty,
service tax,
and also
and the oil price hike,
and also the adjustment in a number of prices. All of this will push it up, so that it is still possible to get an inflation rate around 6.5% during the next year. But this is also predicated on one big assumption, that agriculture monsoon will be normal, and agriculture will be normal during the next fiscal.
Okay. So we are assuming that the agriculture supply side easing that has happened over the last, say, 4-5 months will continue. That's what you
Yes, I am only saying that at this particular point we do not know how the monsoon will behave.
Okay.
But so long as the monsoon behaves reasonably well, then the bumper crop of the previous year, plus the expectation of a reasonably good crop, should dampen food inflation, and that will have a salutary effect.
Okay, you're talking about the food inflation expectation,
right?
Which monsoon, good monsoon
will somewhat dampen it.
And sir, coming back to manufacturing inflation, do you think it's moderating? At the moment, it's a little below 6%. Or?
Yes, I think in February we saw the headline inflation rising slightly over the January headline inflation, but the manufacturing inflation came down by 1 percentage point. It is still high, but it has come down. The only impact that could push up the manufacturing inflation is the immediate impact of the rise in the excise duties. That can have that effect, and also if administered prices on on diesel and others are adjusted, then it will also have an indirect effect upon manufacturing prices. Therefore, the manufacturing inflation may go down slightly in the next 1 or 2 months, but may stay at that particular level during the rest of the year.
So here, I have a slight worry which you might like to throw some light on. I have spoken to some of the manufacturers like Maruti Udyog Limited, the largest car manufacturer. Their chairman the other day told me that he is operating at more than 100% capacity, and yet he has not planned new investments. He wants to plan another plant, but he is a bit skeptical about demand picking up. Now, similarly, there are other sectors where people are 100% capacity, close to working on 100% capacity, but not really planning, or if not planning, implementing additional. Normally, they say that if you've crossed 80% capacity, you start planning additional capacities, investments. So, do you think this could put some pressure if demand increases, put pressure on inflation.
Well, I mean, even if they decide to invest now, it will take some time before the impact of that investment in terms of additional production will take place. Therefore,
to that extent, in that
investment
period-
must always be anticipatory. I mean, it must anticipate demand.
That's what puzzles me. In these cases, it's not anticipatory. You know?
But I think that if we grow at something like 7.5 or 7.6% during the next fiscal, then further capacity creation in many of the sectors will start. And therefore, investment rate, which has dropped in the last 2 years, can pick up in the next fiscal if we continue to grow, or if you grow at the expected rate of 7.6% or a little over that.
And sir, I remember you telling me when the last big recession happened, 2008-9, you were prophetic when you said, at that time I spoke to you, you said that there will be a fast recovery, because you said there are a lot of investments were in the pipeline, so investment-led recovery will continue. Consumption may have slowed down temporarily, but that also will eventually follow the investment growth. Do you think that situation exists today? Because I get the feeling that investments are drying up, new investments.
Yes, I think the situation is somewhat different. At that time, in 2008-9, because of the very fast rate of growth in the previous 3 years, there were a lot of investment in the pipeline. Somehow the impression now is that the investment in the pipeline has slowed down. And but while it will have some impact, but if there is a strong indication that the economic growth will pick up during this year, I expect companies to invest very quickly. And since they already have reached the near full capacity, they may be willing to move very fast on investment.
Investment, yeah. So here we'll take a small break here. Please don't go away. Keep watching Raj Sabha television. We'll be back. Welcome back to State of the Economy. We are having a conversation with Dr. C Rangarajan, Chairman of Prime Minister's Economic Advisory Council. Dr. Rangarajan, we were discussing the conditions under which investments can pick up, should pick up, and we could have a high GDP growth this year. In that context, the question that comes to mind is that in several areas in our country, in our economy today, there is a lot of demand. It's a supply which is lagging. Whether you take coal, whether you take minerals, in fact even fertilizers. I am told that there is so much demand for fertilizer for farmers, and the government has just worked out on a new fertilizer investment linked incentive policy. Now, could you just throw some light on what are these supply side constraints which if improved, which if dealt with, will actually could give GDP a good kicker?
Well, I expect the GDP growth in the next fiscal to be around 7.6%, which will be about 0.5 percentage point higher than the current year. I will give 3 reasons as to why I expect the growth rate to be higher next year. One, inflation will be somewhat moderated, and the moderation in inflation can lead at some particular point during the year to the easing of the monetary policy. And therefore, that will help both in terms of stimulating growth as well as investment.
Could it be immediate in the next month, this monetary easing that you're talking about?
I am not that sure about it, because that will depend upon what the numbers for the month of February will show.
Okay, sir. Carry on.
But during the course of the year, it is a possibility. Second, I think that the investment in some of the key infrastructure areas like coal, power, roads will be met during the year. Because there are indications in the budget about the need for ensuring that the output of coal or the output of power is maintained according to the budget, according to the targets. Therefore, an improvement in the production of coal, power,
fertilizer,
roads and fertilizer will itself act as a great stimulant.
And these are areas where the supply is actually lagging demand.
Right, and therefore the stronger action on the part of the government by itself will act as a catalyst for the private sector investment to happen. Thirdly, I also
can you take a guess? I mean, can you give us an estimate of these four sectors? How much of a GDP kicker can it give? I mean, roughly.
No, I think the primary impact will be on investment. For example, if the capacity creation in the power sector is expanded or something. Now, I think the extra growth that we are talking about between last year and this year could come as a result of the expanded investment and capacity creation in these sectors. About 0.6, close to 1% or a little less than 1% of the GDP can be attributed to much larger investment
in these four sectors that you spoke about. Okay.
And the third reason that I would attribute is that there could be greater clarity during the year on land acquisition, on environmental issues. All of this can lead to larger investment. But as I mentioned a little while ago, that if the economy starts picking up, since the corporate and sector is already geared for expansion in investment, once that growth, pickup in that growth happens, then possibly investment can also happen almost simultaneously.
Almost simultaneously, okay. And now, sir, coming back to the other worrisome indicator which you have mentioned in your report recently, which is the current account deficit. Now, what do you expect the current account deficit to be like in the coming fiscal? Because in the current year, this fiscal, you've projected it to be at 3.6% of GDP. Now, will capital flows be better, and will they improve, and what sort of current account deficit are we looking at?
See, in the current year, the current account deficit we have estimated at 3.6% of the GDP. This is what both the economic survey and the budget also mention. There was some fear, particularly in the quarter ending December 2011, whether the capital flows will be adequate or not.
Yeah, because in that quarter I think it was 4.5% the current account deficit.
And the current account deficit was high, and the capital flows were inadequate, and therefore that put pressure on the rupee, and the rupee started depreciating very sharply. But since then, that is since the end of December 2011, the capital flows have resumed. Both equity capital has been coming in, and there are also indications that the FDI investment is also increasing. Therefore, my current estimate is that for the year as a whole, the capital inflows will be adequate to cover the current account deficit.
Deficit of 3.6%.
3.6%. And the addition, of course, to the reserves will be very, very minimal. But the capital flows will be adequate to cover the current account deficit. But it is also true from this experience that if the capital flows are not continuous, and if the capital flows come in fits and starts, then it puts pressure on the rupee in those periods in which the capital flows are not adequate to cover the current account deficit. True. Now, moving to 2012-13, our present estimate is that the current account deficit will come down to 3% of the GDP. Okay. And this is partly because of the fact that gold imports, which were extremely high, which are extremely high in the current year, will come down. Okay. One of the reason is, of course, the higher price of gold, also because of the higher import duty. The other is the fact that if inflation moderates, then the import of gold as a hedge against inflation will also come down.
Why are people buying so much gold in India? I think gold imports increased by about 60-70% this year as compared to.
See, you have to decompose the import of gold into three parts. Okay. One, the import of gold that is required for the purpose of export of gold jewelry. Then there is the import of gold for domestic use as jewelry. Then there is the one more part which is pure investment. That increased quite substantially during this year because of the high level of inflation.
So that you say that will get moderated next year.
That will get moderated, and that will get moderated along with the situation where the inflation is moderate and the return on financial assets is kept reasonably high. Therefore, then it will come down. Then our estimate is that it will come to 3% of the GDP, in which case the capital flows will still be adequate to cover the current account deficit.
Okay. So sir, if you take away the gold imports, which are purely investment driven, as you said, which people are buying as a hedge against inflation, if you take that away, then would it be fair to say that our current account deficit should average at about 2.5% of GDP?
Well, you see, if you take away all gold import, then it's we are almost on balance, because the gold import total is almost equal to the current account deficit.
Oh, so the gold is the
Right. But that is not the right way of doing it, because there is always a need for import of gold in this country because of basic desire on the part of people to have gold. Therefore, if you take away something like 15 to 20 or 20 billion out of that, then it will come down to possibly to a little below 3% of the GDP.
Okay. So sir, you suggesting that that the current account capital account balance will not be an issue at all in the next fiscal for these reasons, that gold may not become the
my point is only that in the next year the current account deficit will still be high. I think 3% of the GDP is still high, but the capital flows will be adequate.
You say, and half of that will be gold, as you suggested.
But there is a note of caution. I think we cannot afford to continue with current account deficit of 3% of the GDP indefinitely. I think we really need to move towards reducing it.
Okay.
I think that we should work towards that.
Thanks a lot, sir. On that note, we end this episode of State of the Economy. We'll be back with another episode soon. Thank you. Goodbye.